Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, I want to talk a little bit about index investing. It's a topic we've covered quite a bit on the podcast in the past, but we haven't talked about this discussion, this dialogue about whether index investing is bad for the markets. There are those out there that are concerned about liquidity and price discovery. They're concerned about competitive pressures and proxy voting and ownership, common ownership, that is. And because the markets have sold off a little bit this year, Q1, and then also in Q2, particularly since the Fed announced their interest rate increase here a couple weeks ago, which I'm sure you've all noticed. Since the markets have sold off, this discussion has found its way back into the news. And there are those out there, some economists, some other people who think that we might need to intervene in terms of limiting the advent of index investing. And so there's this ongoing dialogue on this issue. And in today's episode, I wanted to talk through this and go through each of the arguments against index investing and why people might think it's bad for the markets. I'm someone who does not think it's bad for the markets. I kind of side on State Street's side with this. State Street a couple of years ago published a really good paper going point by point, debunking each of the arguments made by people who are concerned about the growth of indexing. So in today's episode, I wanted to go over what each of these arguments against indexing is and why they're not terribly valid. Again, I side on the side of State Street, who is certainly biased because they're one of the biggest index investing operators in the world. But nonetheless, they make some pretty good arguments. So that's what today's episode is. I hope you enjoy it. Also, real quick, the show is growing. We're really pleased with our download numbers. Things are going very well, and I'd like to continue that growth. And so if you have a moment, please head over to iTunes or Spotify or wherever you get your podcasts from. Drop us a 5-star rating and a positive review, and it would really help our listenership. Thanks in advance. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Alrighty, this week on the show, I would like to dive into index investing. We've talked a lot about index investing over the years. You've probably heard of it before, but you've probably also noticed that year to date, the markets have been a little bit temperamental. We've got interest rates on the way up, a lot of concern about whether we are headed toward a recession or whether the Federal Reserve will be able to navigate us toward a quote-unquote soft landing. However you want to describe it, stocks and bonds have both fallen pretty substantially in value since January 1st. And this experience has reignited a discussion and even an argument about whether index investing is good for the economy and good for the markets or not. Because there are some out there who are concerned that as more and more of the investing world starts adopting indexing as their strategy, that is going to have widespread ramifications across the market that might not be so good. There are 3 or 4 main arguments against index investing. And it might have been 12 or 18 months ago, maybe even longer than that, State Street, which is one of the major index fund providers out there, State Street and Vanguard are 2 of the top, published a paper responding to these criticisms. And because this topic and this discussion has been reignited because of market performance recently, I wanted to cover my take on this, what those arguments are, and what State Street's responses are. By and large, I agree with how State Street responded. And as you can imagine, They are a huge provider of index funds. They think that those criticizing indexing in general, those arguments are a little bit off base. Yes, they have a vested interest in index investing in the first place. So yes, there's a little bit of bias and perhaps conflict there. But as someone who's been involved in this stuff for quite a while, I think that State Street makes really good arguments and the criticisms are not quite as strong. But this deserves further discussion. And so I wanted to cover this today because it is a headline that's popping up in the news over and over and over again. And again, because the markets have dropped off a little bit here on us recently, more and more people are asking about whether this is actually good for our economy, our country, our world long term, or whether we need to have more balance in terms of strategy that everyday investors are taking. So what I'd like to do, if you're watching the video, you can see me look over at my other screen and at my notes, is just go through these points one by one. There are four main arguments. State Street, in my opinion, debunks them all. But the first one is that when we have more of the investing world adopting indexing as their strategy, it reduces competition within an industry. And so before we dive into this, I'm going to throw a couple statistics out there. Back in 2017, of all the mutual fund and ETF assets in the US, and I don't know how large that pool is, but in 2017, only 35% of that pool was engaged in index investing. And when I say indexing, a lot of you, I'm sure, intimately understand what that means, but you're investing in a broad group of securities without trying to pick the winners and avoid the dogs. So a lot of us think of index investing as buying the S&P 500 index fund, maybe SPY is an ETF that tracks the S&P 500, or maybe Vanguard's Total Market Index, VTI. There are a lot of different indices out there, and index funds could track specific industries or specific types of companies or specific geographies. It really doesn't matter. All of those groups are considered index funds. The main point is that you're not engaged in a strategy where you're analyzing every single specific company, looking at their operations and their growth and their research and development, and then making a projection of how well that company and that investment will do in the future. You're just investing in everything without going through that exercise. That's what index investing is. And as we talked about on the show quite a bit, that list of securities is just a list that an index fund manager is provided by the operator of that index. So the S&P 500, again, Standard & Poor's maintains that list of the 500 biggest corporations domiciled here in the US. Every quarter, that list reconstitutes. They send the list over to State Street, over to Vanguard, and they buy and sell securities pursuant to what's on that list. So when I say index investing, I don't just mean the US or the total market or the S&P 500. I mean any strategy that just takes a list of securities that the manager is handed from whomever that list provider might be. And the first criticism of this, well, let me back up. I promised you a couple more stats. So in 2017, 35% of mutual fund and ETF assets were in indexing strategies. The other 65% were more active strategies, where the managers are looking at the specifics of each company and then making portfolio and buy-sell decisions based on the merits of that individual company. They're not just taking what's on the list and buying that. 2 years later, in 2019, half of ETF and mutual fund assets were in indexing strategies. I could pull up the number in probably 30 to 60 seconds of what the market share is today, but I won't bore you all on the episode today while I go ramble for a minute while I find it. But I can guarantee that the market share of all assets in mutual funds and ETFs today is greater than 50% where it was a couple of years ago. So people are a little bit concerned about that for a couple of reasons. The first reason is that some out there think that as more assets flow into these indexing strategies, it's going to reduce competition within an industry. Because if let's take a simple example. And the example given in the argument, there was a paper that came out, I don't know who published it, arguing that when there was common ownership across all the major airlines, meaning, BlackRock or State Street or Vanguard blindly owned all the airlines on the list because they're an index investor, that the prices of airline tickets go up by $3 to $7 each. And so if you have common ownership by virtue of index investing, then the companies are not as incentivized to compete on price. You don't have the same pressure because your boss also owns all the other airlines and it doesn't matter. It's an anti-competitive kind of arrangement. That was the argument. And I've not read that paper on myself. I don't know whether it was based on sound or unsound methodology, but the argument that State Street comes back with is, yeah, that's possible if you're only concerned about that one industry, airlines. But if you're an index investor, you're not just investing in airlines, you're investing in all the other stuff too. And so if you also have common ownership in another industry that might buy airline tickets, that issue goes away because more profitability from the airline industry, if ticket prices go up by $3 to $7 each, because there's one owner of all the airlines, that's going to mean that the airlines are a little bit more profitable. But guess what? The other industry that buys airline tickets, their profitability is going to go down by the exact same amount. And if you own the other industry too, at the end of the day, it's not going to make a difference whatsoever. So that, my sense is that that's a reasonable response. And the vast majority of those indexing assets, which again was 35% of all mutual funds and ETFs back in 2017, went up to 50% by 2019. It is absolutely greater than that today, although I don't know what the exact number is. The vast majority of those assets are not focused on one specific industry. There is a small sliver out there, right? You can go find an ETF or a mutual fund that invests only in airlines or only in financials. They do exist, but it's a very, very small portion of the overall market. The vast majority, because it's a strategy that's worked and benefited people for a really long time, the vast majority of these funds are blanketing multiple industries based on a broader list of securities. And that really dilutes that argument, in my opinion. So that's number one, is index investing reduces competition within an industry. The problem is that indices don't invest in just one industry. They invest in all of them. That's kind of the whole point. The second is that corporate governance standards will weaken as indexing grows. And so here's what we mean by that, right? If you own an airline and I own an airline, you have control over the operations and management, right? You might have a CEO who's handling day-to-day operations. They report to you, the owner. You can fire them and replace them if they don't make a good decision. Same thing that I can do as well. And what the argument is that with common ownership, when the index fund owns all of them, not only might that be anti-competitive, which again, I don't feel is a strong issue, but when it comes to making decisions at the board level that investors have to weigh in on, the argument is that the index fund responsible for voting proxies, voting in and out management, is not going to be as responsive and able to make sound decisions based on the best interests of shareholders as active managers are. So I'll say that again because I rambled through the point quite a bit. When you own shares in a company, there are often decisions that have to get voted on by shareholders. Elon Musk has a bid to buy Twitter, an offer standing on the table to buy Twitter. The board has voted to accept it in the sense that they're going to recommend that shareholders approve it. But the shareholders still have to approve it, right? So if there's one common shareholder across all the airlines, the argument is that an index fund is not going to be able to successfully act in the best interest of the index fund shareholders. And what we're forgetting here is that there's a powerful mechanism called fiduciary responsibility. And when you're making those proxy voting decisions of, we've had this takeover offer for our airline, maybe my airline offers to buy your airline, you have to make a decision that's in the best interest of all the shareholders. And guess what? If you don't, either because you're neglectful or self-interested or whatever, the other shareholders have legal recourse to come after you. And this happens a lot, coincidentally, especially with activist investors. If other shareholders think that you're acting in your best interest before their own and make not just a poor decision, but a reckless decision, then they can come after you in court, and they do. And so for that reason, Vanguard, State Street, BlackRock, all these major managers of index funds put a lot of resources into engaging with company management and voting proxies in a way that's beneficial to their shareholders. They don't neglect that function at all. And I know that I don't have any hard data or evidence, and I'm sure this stuff has been studied, but it is, you think that because State Street owns all the airlines that they're not going to pay attention dutifully to the proxy voting decisions that they have to weigh in on when they own a lot of shares and have some sway over those decisions. That's not the reality. That's not how it works. They actually do look at those things quite closely and devote a lot of resources to them. Number 3, and this is the one that I probably hear most common, is that when more of the investing universe is buying everything on the list, this hurts price discovery. And what that means is that the price of anything in our capitalistic economy just depends on supply and demand. Back to Economics 101. And that includes gas, it includes stock prices, it includes the value of your house, right? So it's all based on supply and demand. And if you and I are working with the same information, and we're both very sound investors capable of making good investment decisions, and you think that Tesla is worth $800 a share, and because I drive a Tesla and I really like the Tesla and I'm biased and that has led me to a poor decision because of how much I like my car, even though I'm working with the exact same public information that you are, I might be influenced by that and think that Tesla is worth $1,200 a share. So guess what? If you think it's worth $800 and I think it's worth $1,200, I'm more likely to bid it up. You're more likely to sell it if the price is somewhere in between those two extremes. And the whole idea behind price discovery is that you need people actively evaluating each individual investment to weigh in on that market price. And if it's trading at $900 a share, I might want to buy it and raise the price. You would probably want to sell it because you think it's only worth $800 a share. What I'm trying to get at here is that there are small price inefficiencies throughout the market in numerous ways. And that's basically why hedge funds were started. They exist because they see these little inefficiencies. And I'm giving you a poor example. A better example is let's go back to Twitter, another Elon Musk thing. So right now, Twitter is trading at less than $54.20 a share. But there's an offer on the table by Elon Musk to buy it for $54.20 a share. I mentioned this on the show a couple weeks ago. This is a merger arbitrage, where if you buy it where it is right now, you're betting that the deal will close and you'll get $54.20 a share for your investment. But if you don't think it's going to close, then you might want to sell it short, or at least sell it long if you already own it. Because if it doesn't close, it's likely to fall back to where it was trading before this deal was announced. These kinds, and again, it's a little bit of a speculative bet, but these kinds of inefficiencies in both directions are how we arrive at prices. Here's another arbitrage that's good for markets. It's the way that exchange-traded funds are created and maintained over time. We've talked about this quite a bit over the years, so bear with me if this is redundant to you. But with the mutual fund, you fork over money to a mutual fund manager, they add that money to the portfolio, you get a commensurate number of shares in the fund based on the net asset value that day. It's a direct exchange. If the mutual fund is the S&P 500, we figure out what that is worth, how much one share of that mutual fund is worth based on the market prices. If you give over $1,000, the manager divides that $1,000 by the net asset value of the fund that day, you get the resulting number of shares. And the value fluctuates in lockstep with that over time. With an ETF, each of the 500 individual companies is actually purchased by an authorized participant out there in the market, one of the big Wall Street banks. They take the 500 companies, they stick them in trust somewhere, and then they exchange them temporarily. So the 500 shares of stock are locked up somewhere, and they have the ability to create one share of the ETF, which they can sell to you on the open market. They have that exchangeability. And so because the ETF trades on the open market, and each of the 500 companies also trade on the open market, there can be a discrepancy between the price, where the value of the ETF, which should be exactly equal to the 500 companies that are in the fund, sometimes they deviate. And that's when other banks get involved. And so if the relative value of the ETF is greater than the 500 companies, well, then somebody else down the street is going to buy the 500 companies, sell short the ETF, take the 500 companies, create a share of the ETF, and then close their short position and then profit from that difference in price. That's an arbitrage opportunity. And so the argument against indexing here goes, as it goes, is that it hurts price discovery because there are fewer active managers and active investing activity across the market. And when you have fewer participants actively betting on the price going up or down, those inefficiencies and arbitrage opportunities persist. And they're not, quote unquote, arbitraged away because you have fewer actors closing that gap and taking advantage of it. This, in my opinion, would be a valid argument if the only participants in the markets are people, retail investors like you and me, who have a choice between, do we want to buy a whole bunch of individual stocks? Do we want to buy an actively managed mutual fund or ETF, or do we want to buy an index product instead? Well, if we're the only people in the market and the amount of assets moving toward indexing is growing rapidly as it is right now, this could be a concern. The problem with that argument is twofold. Number one, it doesn't take a whole lot of active participants to arbitrage these things away. And we'll use the ETF example for one. Your risk in that example that I gave, if the value of the 500 shares of stock in the S&P 500 is $1,000, but the commensurate number of shares to which you're entitled to the same 500 companies is worth $1,100 on the open market, well, you buy the 500 companies, you sell short the ETF, you have $100 cash in the bank and a short position in the ETF. Then when the trade settles, you create the ETF using your purchases, close out your short position, and you walk away scot-free with the $100. In reality, it's not actually a 10% return. It's a heck of a lot less than that. But the point is that it doesn't actually take that many active participants in the market to work those arbitrage opportunities away. Because guess what? You're not the only Wall Street bank that has the ability to engage in this market. There are a dozen others too, and you're not the only one who's seen it. So if you keep buying, if there's this $100 difference between the shares and what the ETF is worth, you're not just going to do it once. You're going to back up the truck and do it over and over and over again. And so maybe after day one, the difference, maybe on day one, it used to be $100. On day two, it's only $80 difference, because you and all your colleagues and all the other banks on the street have executed the same trades and tried to take advantage of the same pricing discrepancy. The more you buy the underlying stocks, the more the price goes up. The more you sell the ETF, the more the price goes down, and it closes that gap. And it doesn't actually take that many active participants to do that. Furthermore, the active participants that are in the market have deep pockets, and they're going to do that over and over and over again. So back to my point here is the fact that more ETF and mutual fund assets, the fact that they're engaging, that more of those assets are engaging in indexing strategies hurting price discovery. Well, maybe that would be a concern if you and I are the only people in the market, ordinary, regular investors, but that's not the case. You have pension funds. Pensions they do a lot of indexing on their own, but they're also making active bets. You have hedge funds that have a lot of trading volume. And again, they call them hedge funds because you're taking advantage of arbitrage opportunities. You're hedging risk by jumping into this kind of stuff. They have huge amounts of money and are very good at arbitraging these things away very quickly. That's a pretty large portion of the everyday trading volume on the NASDAQ and the New York Stock Exchange. You have insurance companies that invest in individual securities as opposed to indexing for a number of different reasons, mostly risk management from their perspective. And you have more institutions like endowments, some of which engage in index investing, but a lot of times they want to have exposure to individual companies for various reasons too. And the motivations for all these institutional investors, again, pension funds, endowments, hedge funds, insurance companies, are totally different than those for you and me. And yeah, they might want to have some market exposure through an indexing strategy, but there's a lot of individual stock picking for whatever reason, not just because they think the price of Tesla is going up, but because they see some inefficiency and they're buying a whole bunch of shares for some other reason, and their market exposure is hedged through an option or maybe a futures contract or something else. There's a lot of ornate stuff going on behind the scenes. And so because a lot of the trading volume is a result of institutional investing, that kind of debunks the argument that more long-term buy and hold individual investors, which is of long-term horizon, or at least is what most individuals have, the fact that more of their assets are moving toward indexing hurts price discovery. It just doesn't work in my mind, because there are a lot of people beyond that one pool engaged in this market activity that we're talking about, and those actors have really deep pockets and account for a heck of a lot of trading volume. So that's number 3. Number 4, the last one, it goes in a little bit of a different direction, but the argument against it is that we don't like index investing because it exacerbates income inequality. And as this argument goes, because it's easier to purchase an index fund, that reduces barriers to entry. And because this strategy performs better, that means that those that have the ability, the capacity to invest and partake in the stock and bond markets are going to see those savings grow faster, and therefore the haves will have more money, but the have-nots, who don't have the opportunity to participate in the markets, won't. And I just don't see this one. The fact that you would want to, or even be concerned about reducing barriers to entry by virtue of offering indexing to a wider population of people, concluding that would exacerbate income inequality just doesn't make a whole lot of sense. Because to me, the advent of index investing and the fact that it's reduced barriers to entry in the first place opens up the capital markets to a wide variety of people, a wider variety of people. It might be, you might not have been someone who wanted to have or had the ability to have a relationship with the broker through which you had to execute trades 35 years ago. Now, anybody with $100 can deposit that in an account and then go buy an index fund. And it's the barriers to entry are so much lower than they were before. So that argument to me just doesn't make a heck of a lot of sense. And of course, there are a hell of a lot of people across our country that don't have $100 to put in an investment account. And even if they do, a lot of people in that situation might not have the understanding or ability to do that. Internet connectivity could be an issue. But it just goes back to spending a little less than you're earning. And I just can't see the fact that index investing leads us to better outcomes, and the fact that it's easier to engage in as an argument for pulling back on it at all. And so, maybe perhaps because more people are going to see greater returns through the strategy, maybe 10 years down the road, the difference between the haves and the have-nots, perhaps that's a little bit greater, I guess. But it's still a good thing in general that the barriers to entry have gone down in the first place. I almost talked myself out of that one, didn't I? Suffice it to say that this argument comes up from time to time. Anytime that there's a major trend or movement in the market, a lot of people are uncomfortable about that, right? Change is hard. But this is clearly a strategy that benefits people. It should be most of our core strategies. If you want to take 5% of your portfolio and manage it more actively and pick the ponies a little bit, by all means, go ahead and do it if you have the capacity for it. But by and large, I think for most people, our core strategies should be long-term, consistent buy and hold indexing, because it minimizes the opportunity for our behavioral biases to get in the way and our emotions to get in the way of sound decision-making, and maximizes the chances that we're going to have a very favorable investment outcome in the future. That's not because I think that the U.S. is always going to be the leading world power, not because, I think that we're never going to have another recession. It's because when you engage in this strategy, you're buying a whole bunch of different corporations and a whole bunch of different debts. And by participating in that capitalistic process where you buy a whole bunch of corporations with governance and controls and intentions of being a profit-making machine, you get to benefit from that over time without risking whether you're making the choice of whether Lowe's or Home Depot is going to do better over the next 10 or 15 years. It spreads the risk out as much as you can and just generally leads to positive outcomes. So that should be the core. And again, the arguments against it, some people think that indexing across common ownership, so the same index fund owns all the companies in an industry, that leads to decreased competition. Even if it doesn't matter if you're owning all the other industries as well. Number two, it'll lead to weaker corporate governance standards. That's not been the case historically. It leads to really strong corporate governance because the mutually owned companies like Vanguard have a lot of resources that they've deployed toward their proxy decisions. And if investors ever feel like they really went the wrong direction, there's legal recourse there by virtue of their fiduciary responsibility. Number three, indexing hurts price discovery and market liquidity. Not true. It doesn't actually take that many members in the market to achieve desirable price discovery. And there are institutions that actively trade all the time that are not going away anytime soon because they're strategies are different for a number of different reasons. Concern number 4, the rise of indexing is going to exacerbate income inequality. And this is the one that I'm least confident in my response to. And as you can see, I'm kind of siding with State Street. Again, State Street is, they have a conflict. They're biased because they're one of the biggest producers of index investing. But suffice it to say, when you see in the news that index investing is bad for the markets, it hurts liquidity, it hurts price discovery, whatever, personally, I don't agree with any of that. Maybe I could be convinced on the income inequality thing, but that's not a good enough argument to pull back the reins on index investing, certainly not through policy or regulation. Okay, that's it for today. Hope this was halfway interesting. This is an argument that comes up every now and then, and has certainly been in the news recently. Have a good week, and I'll talk to you all soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.